Hello and welcome to another episode of Frankly with Mercer Wealth Management. I'm Emmett Cosgrove, Vice President and Partner at Mercer Wealth Management. Today, I want to be frank about the situation surrounding Silicon Valley Bank and other regional banks that led to its ultimate collapse. What I want to focus on are the facts that preceded the situation and also what we're calling social media hysteria that led to a lot of fear and panic selling that impacted this event. Let's first take a look at some of the facts and the timelines that led up to it. At its root, the bank's failure was caused by a decline in startup funding, rising interest rates, and the firm's sale of government bonds at a huge loss to raise capital. During the liquidity surge of 2020 and 2021, SVB experienced a rise in deposits from venture capitalists and startups that were flush with cash. SVB decided to invest a large amount of these bank deposits in long-dated U.S. Treasury bonds. But when the Federal Reserve hiked interest rates in 2022 to combat inflation and signaled it would continue to do so, the value of SVB's bond portfolio began to drop. At the same time, rising interest rates put pressure on the tech sector. Many bank customers withdrew money as venture capital started to dry up. Because SVB's capital was committed to long-term investments, it lacked the cash on hand to meet customers' liquidity demand. To raise capital, SVB decided to sell a $21 billion portfolio of Treasury bonds in a 24-hour period and took nearly $2 billion in losses on that sale. Within 48 hours of disclosing the sale of those assets, a run on deposits caused the bank to collapse. As I'd mentioned, social media hysteria was one of the primary drivers of these events. It's something that regulators are concerned will continue to persist and be at the forefront of a lot of events moving forward. Let's take a look at a couple of these prominent tweets from well-known influencers in the space. This first tweet is one from Jason Calacanis, who's an angel investor and tech startup guru who's well-known in the space. As you can see, on March 10th, he ended the tweet with saying DEFCON 1. Well, that's certainly not going to lead to a lot of good feelings and security out there in the markets. Next, you've got a tweet from actually a House of Financial Services representative, the chair of the House of Financial Services, named Patrick McHenry, who's quoted to say, "This is the first Twitter-fueled bank run." Now let's take a little bit of a closer look at the timeline that surrounded this social media hysteria. I like to summarize it in about 8 steps. 1, a well-known VC reporter posts an article on Twitter calling out SVB's financial risk. 2, pretty much every venture capitalist and angel investor reads the newsletter. 3, they all start to pay very, very close attention to SVB's earnings. 4, there's an absolutely massive earnings miss by SVB. 5, Peter Thiel and other influential tech portfolio managers are first to send out messages and mass emails to portfolio companies to start pulling out funds from SVB. 6, tech Twitter catches word of these mass emails. 7, the bank run on deposits begins. And 8, the eventual collapse. The social media hysteria didn't stop with SVB's collapse that Friday. In the following days, influential investors took to social media and stoked fears about what the collapse would mean for other banks and the tech sector. They warned that if SVB's customers were not made whole, other bank runs would ensue. So, what did we at Mercer Wealth Management do in response? I'll tell you what we did not do. We did not take to Twitter to start adding to all of this fear that was out there in the markets. What we did was put together a newsletter that we published for our clients. You should have received it. It included information surrounding FDIC insurance, the security of their banking deposits, and what that meant. We also discussed some news that was involving Charles Schwab and discussed the safety and security of the assets, rules and regulations of those assets custodied at Charles Schwab. If you didn't receive that newsletter or want to have a further conversation about those issues or this issue, please feel free to reach out. We can either get you the newsletter or have a conversation. because it's very interesting events, and I don't think this is the last we'll see of it. But we'll continue to monitor. That's all for now with this episode of the Frankly podcast. I hope you enjoyed it. If you did, please definitely share, like, subscribe, all of those things. Send it to friends and call in or email with any questions you have. Thank you for joining this week's episode of Frankly with Mercer Wealth Management, and we look forward to giving you more advice, frank advice in the future. Until next time.